there is one thing that always matters, regardless of stage, is the founder actually. And like this, everybody says this, but they say it because it's just so true. And like there's certainly a few attributes we look for in founders. And I actually think Lloyd said something very wise in one of the podcasts where he looks for founders who have strong opinions loosely held. And I think that is very, very important.
This podcast is sponsored by Pragmatic Solutions, the player account management platform chosen by today's smart betting and gaming operators. Don't let technical constraints delay you from achieving your business goals. Expand your business, boost your margins, and dominate the market in any leading regulated jurisdiction with our powerful, flexible, and secure iGaming platform. Enjoy its extensive marketing tools, compliance protection, real-time data, and a wide portfolio of over 1,000 industry providers. It's time to upgrade your technology. Let Pragmatic Solutions show you the modern approach. Visit pragmatic.solutions and join the smart thinkers.
This podcast is brought to you by Pragmatic Play, a leading game developer providing player favorites to the most successful brands across the industry. With an award-winning multi-product portfolio of slots, live casino, bingo, virtual sports, and more, Pragmatic Play is powering up new possibilities of play through one single API. Visit pragmaticplay.com and discover your favorite every time.
Bingo, bango, bongo, Evert Einroos, Managing Director of Yolo Investments. Congratulations on the promotion.
Thank you so much, Pierre.
Good to have you here, my friend. And we've known each other since the very beginning, you could say. We got investment by Yolo Investments in November of 2020, and coincidentally, that was the month that you started with Yolo as well, and it's been quite some ride since then, I imagine, yes?
Yeah, on both sides, I'm sure. And yeah, I mean, first of all, thanks for having me on. As I said, like this is quite special for me, having followed your journey as an entrepreneur and like the journey of Next as a business for 5 years now. So it's special for me.
Yeah, it's great to have you here, Evert. And today we're going to talk a little bit about kind of what it takes to run a full-blooded VC fund, right? And Yolo Investments has been on a tear in the last couple of years, and a massive amount of millions of euro assets under management at this point. Recently launched Fund 2, where you took in external capital from LPs. But let's go back to the origin story first and foremost, Evert. Can you talk about kind of the early days of Yolo Investment when you joined then in kind of November 2020? How did it all work at that time?
Yeah, sure. So it actually started a few years before that, which is a very atypical VC story, I guess. But Tim and the other shareholders of Yolo Group, which is the parent organization here, the business were doing quite well. If I remember correctly, actually that year the NGR of the B2C brands was up 5x year over year, and there was a classic founder dilemma: do we cash out or do we double down? And I mean, Tim well. The answer was obviously to double down. So
it was a short thought process.
Yeah. So we started this small instinctive bets. Like I guess you could say we were somewhere between a family office and a corporate VC, and these are both like fancy and professional words. But at the end of the day, we were operators trying to solve the pain points we had. So we had a lot of operating experience. We saw the pain points. We figured if we find services and products that help solve them, if it works for us, it might work for other operators. So it very much started from there. And yeah, I think you could say we were very much a startup ourselves, like a lot of focus on performance, not that much on process at the beginning. It was okay to fail as long as you adapt and pivot quickly. All the usual stories you hear about, like deals being agreed on napkins, and like that was all us, like working nights and weekends to go through due diligence, and it's not that dissimilar to building an early stage business actually.
Yeah, I remember, in our case, getting in touch with Tim And Tim told me that he was listening to some of our podcasts when he was driving from Tallinn to Poland or something. And when we had the call to discuss, who we were and if we would be a good fit for YOLO, we had that call together with Tim. And at the end of the call, he said, "Yeah, this sounds good. I like what you guys are doing." Yeah, and it was pretty straightforward in that regard. So to that point, I want to ask you a bit more about like those early deals, how they happened, how the thought process were in this case, and then perhaps what were the result of kind of those early days at Yolo Investments?
Mm-hmm. Okay, I think that the best example I can bring here is actually Hub 88 out of the, call it early wins. There's not a pure investment fully. It's also like incubated project internally, but that's a very straightforward example of like the casino development team was spending most of their time in integrating suppliers as opposed to building products for actual customers. So there had to be a better way. It was a very clear pain point. And an aggregator was born, which today Hub 88 processes billions of turnover per month, but like it all started there. But I mean, overall, as with any early stage ventures, the power law distribution of returns very much applies. There is many flops, complete bankruptcies, but a few big wins that kind of make up for it.
Yeah, that's for sure. I mean, it must have been a lot of learnings in those old days, supposedly, making those early deals, and it was exciting times, and in and around the 2020, 2021 era when we came on board, this was, at the kind of top of the hype cycle. Then, of course, crypto crashed, and there was a downturn in the economy. That must have been a challenging period for the venture fund as well.
Yeah, for sure. And like every fund felt it. And I mean, as you said, 2021 was probably the peak kind of call it hype cycle. And like we went a bit like not crazy, but we deployed a bit too aggressively as well. The same as many other funds.
Yeah. Yeah, exciting times. And then, of course, you came out of that storm, let's say, in a really healthy and good manner. And that has led you to the point where you are today, that you are just about to close the second fund of YOLO Investments. And this is the first time you're now taking on external capital in the form of LPs, which is limited partners. So you have the general partners in Tim, Steve, and Julian, and then, of course, the limited partners who invest into the fund at the hope of getting a good return back. Can you talk about why you decided to create a second fund and why you decided to take on board the additional headache, I suppose, of having a lot of other voices involved in the direction of the fund in terms of the limited partners?
Yeah, absolutely. So I guess for background, it was, as you said, first time for us raising outside capital, and like us VCs, we aren't necessarily known for having small egos. So it's a humbling experience that I think every investor should experience. So what we had going for us was the fact that we had battle tested the investment strategy over many years with our own capital, and we did have a strong track record to show for it, and we had conviction in what we're doing. Secondly, we what makes us a bit special is usually the GP or the fund manager puts in about, call it 2 to 3% of the fund. They have some skin in the game. In our case, we figured let's do 50%. So it shows very clear alignment with any potential LP. And I guess the third positive side there would be the journey, as you mentioned. So if I look at us today, we've come a very long way in terms of building up proper industry standard processes, building up the team. We've become regulated, we've become audited. It's been a big growth journey for us as well. Now, on the call it the negative side of things, it was still a first time raising external money, so new experience. It's definitely challenging, and the timing wasn't ideal. So it was 2024 was our main fundraising year, and global VC fundraising was down 30-40% on that year. So not ideal timing, but at the end of the day, we ended up with a group of about 20 like-minded LPs who have trusted us with their money. And like honestly, this is the biggest responsibility for the team. And like we're full on committed to our LPs to make them money.
Yeah, brilliant. And I mean, when you go after startups to deploy capital into, it must be a challenging process in its own right. I mean, the most talented, say, startups will often have a lot of opportunity to kind of pick and choose which fund or which investors they want to have on their cap table. So I'm curious to know a little bit, why should startups be part of YOLO? What is like the selling point to be part of the YOLO investment portfolio as a startup?
Yeah, so in like today, probably every VC will say they're strategic. So like this, almost nobody advertises themselves as like, here's the money and off you go. And what we've been really putting a lot of effort into is, yeah, we say we're strategic as well, but actually mean it and have something to show for it. So the first obvious aspect there is access to the ecosystem, which is we have 150 bit more portfolio companies today. We have our B2C businesses, we have our B2B businesses, more than 1,000 employees, plus the investment team. So having YOLO in your cap table, you get access to all of this network and know-how. Now, second part would be distribution, which like for some founders, that's absolute key. Like what kind of actual revenue can you bring? And call it for a supplier, because we spoke about Hub 88 before. We do have an aggregator with 200 operators. So yes, we can plug you in and come with actual revenues as well.
Brilliant. And the partner retreats helps as well, that we can go and play poker once a year and have a good time at the Chesterfield Poker Club. That's one of the biggest USPs, in my opinion, I would say.
Yeah, that doesn't hurt. And on a similar note, actually, relating to fund two, we look at our LPs the same way. So our LPs are like typical profile is a successful established industry entrepreneur. So being a portfolio company, you also get access to our LPs and their networks.
Yeah, exactly. And that's what makes the YOLO Investment Fund really powerful at this point, right? You have built up that portfolio to those 150 companies that is creating somewhat an ecosystem. There's a lot of synergy between these companies, and being part of the YOLO Fund, it gives you access to conduct business between the ecosystem. It's almost like a trade union. It's like a bit like the European Union. You join it and you get access to the potential commerce opportunities within it there. So that's definitely something that we've experienced at Next, for example, that we can get to the partner event that you organize once a year, get to know the other investment that you have within YOLO. And by extension, there is already a connection there, as you are part of the YOLO family, if you will. And it becomes easier for sure to transact between the businesses. So definitely a major plus in that respect. But then I want to talk about this kind of like, you have obviously really excited entrepreneurs that have this big vision that they come to you with, and oftentimes perhaps entrepreneur might not be that experienced in running a company, or they have this, they are fueled by this like really big energy and they want to conquer the world kind of thing. And how do you deal with the balance of letting founders kind of use that energy and not being held back by you as an investor, but then at the same time balancing that with like not letting the entrepreneurs do crazy shit? You know what I mean? Like, how do you balance that act? Because I can imagine from your experience that you've seen entrepreneurs screwing up along the way, and you obviously want to avoid that in the future, but then at the same time letting the entrepreneurs, run basically.
Yeah. As you said, there is definitely a balance to this, and there's no one single right answer. But the way I think about this is our role as an investor is to provide, you're right, some kind of guardrails when it comes to decision making, and being available, having this support function of whether it's distribution, network, access, whatever it is. But like in my mind, that should still be cherry on top. We're investing in a founder with a vision, and I'm very conscious we are not the main characters in this story. So I like the idea, actually. I think it was one of the 20 VC podcasts where being a VC is like being a founder on antidepressants. So you still feel the highs and the lows, but the amplitude is much lower or much smaller. So like as a founder, if you mess up, if things go bad, if the company goes bust, you're done. But as a VC, like of course that's not great, but we still have like 30 more shots on goal to make it work, and that's very different.
Yeah, it's a good point. And I want to talk a little bit about the process that you go through when you try to decide whether to invest in a company or not. I think it's interesting for perhaps future founders to understand this as well. What do they need to, in what position do they need to be ready to pitch to Yolo Investments? I mean, I imagine that you get a lot of pitch decks submitted to you, and there's only a limited time to read through them. There's only a limited time to make that first call. There's only so many investments you can make. So that must mean that out of 100 pitch decks, you invest maybe in one or something like that. So I'm curious to know, what is the process that you go through to decide whether to invest in a company or not? And what is the most important things that you look for in an investment opportunity?
Mm-hmm. I guess it varies between funds and mostly due to the stage preference. So our fund 2, we invest slightly later stage. Depends on where do you want to draw the lines. I think Series A is the sweet spot. And typically what it means for us internally is the business should have made its first million. So $1 million in revenues, I mean. So there is already something there. Maybe not product market fit, but early signs of it. And like I see our role here is to help the business and be along for the journey from 1 to 10 or 1 to 100 million in revenues, something along that lines. But there is one thing that always matters, regardless of stage, is the founder, actually. And like this, everybody says this, but they say it because it's just so true. And like there's certainly a few attributes we look for in founders. And I actually think Lloyd said something very wise in one of the podcasts where he looks for founders who have strong opinions loosely held. And I think that is very, very important. So having a strong vision and being opinionated, however, when the facts change or the underlying data changes, the founder should be able to change their mind and pivot, not be stuck in their ways. And there's a second side to this, which is a bit more abstract, I guess, which like in VC space, sometimes people say a founder who has taste. Or I think I like the word intuition more, but like the way you build a business, it's a set of decisions, some bigger, some smaller, and like you take many of them every single day. Like no single person can get all of them right, but the best founders get most of them right. And the trick is you often have incomplete information, so you need to trust your gut, you need to trust your intuition, and that is very hard to put into words. You start to develop, if you meet many founders, you start to develop like a gut feeling for it. And I think that's also something we're looking for, but a bit more harder to put into words, I guess.
Yeah, it is kind of, there's a great business concept by Jim Collins, who studied the best businesses in the world. He made that his life essentially, and he boiled that down into a couple of books. And one of the most famous business theory books in the world is called From Good to Great. And it's just an absolute excellent book that any founder, anyone who runs a company should read. And he boils down what makes a company go from good to great into a few principles. And one of them is get the right people on the bus and then figure out where to drive. And the idea is that when a company is at an early stage, you might have a great business plan, but it's almost sure that this business plan will change along the way. But what is much more important is to get the right people with you first. Because when the bus breaks down, when the bus take a wrong turn, when something unexpected happens on this journey, you want to have the right people on your bus to steer it in the right direction again, or to pivot into a new direction, essentially, which inevitably will happen. So you want to have like a functioning bus rather than like a really good plan where it's going to go, right? That is kind of like a good way to think about it, I think.
Yeah, and I mean, the same thing actually talks about the other side of the coin. Like, what are the attributes you maybe are red flags, or like would make us not to invest? And like in there, one specific thing I look for is ability and like being able to admit and to state what can you learn from your failure. So it's very easy. Doesn't matter if it's pitch deck meeting or a quarterly board meeting or whatever it is, to flex with good metrics and show all the things that went well. But I think it takes a bit more skill, I guess, to be able to confidently just own up to what went wrong. And more importantly, what can you learn from it so the same thing won't happen again, and how we're going to improve in the future.
Mm-hmm. Yeah, that's a good way of putting it, Everton. I'm curious to know as well, when out of the investments, if you think about the investments that you have been part of, what is generally the way in to get your attention? So I imagine there's a lot of founders that have no connection to Yolos, that are, sending in a pitch deck and closing their eyes and hoping for the best kind of thing. But then there are others who are well connected, and you already have their number, you already know them, you trust them. They send in a pitch deck, they already have a proven back record. So they might have an advantage to get into that first call and to get your attention and so on. If you think about it, what, like in your experience, how much do you value that kind of like previous trust that you have for a potential investee, or a previous track record? And how often do you kind of pick these, potential gold dust forward that can be shaped into something beautiful, but there might not be that big of a connection? And the reason I'm asking again is there's a lot of people out there who have great ideas, great knowledge, but they might not have that great content network. So I'm curious to know how you view that as an investor when you're trying to figure out whether, this is a worthwhile opportunity.
Yep. So, I mean, cold outreach is always an option, and feel free. Like, it doesn't matter if it's LinkedIn or we have a button on the website, but it's like a open secret in the VC industry that warm intros do go a very long way. And to be fair, it's not that hard, is it? Like, you can search for common connections on LinkedIn, for example, and find an angle. It's like, my point here would be, if you can't figure out a good way to present, maybe the road ahead is not for you, because like building a startup is bloody hard, at least I've heard. So like if you can't get over that step, then there might be bigger problems, which honestly, I think it leads back to one of your previous questions about having like good intuition as a founder. So like I am a strong believer in how you do something tells something about how you do everything. So all of these small things matter. It's not just about building a great product. How a founder presents himself or herself, how you write a WhatsApp message, how do you design a pitch deck. All of these small things matter and tell like I believe tell something about the person.
Yeah, it's a great point. So it's kind of like a litmus test, the outreach itself, where it's like if you are submitting your pitch deck cold, well, maybe that in itself is then a sign that you haven't done your homework well enough to ask for someone like your time, which is limited. You can't take meetings with everyone. And so there has to be, a good presentation there that entice you to pick up the phone, essentially. And that's the first test, right? To some extent.
Yeah. There's a story here which, okay, because I said it's important to own up to your mistakes, I'm going to share it.
Great.
The founder of Double, John, actually submitted their pitch deck via our website. The unfortunate thing is, we were in the middle of building up this process and actually developing the backend solution to support this. So what very regretfully happened is it got missed. And I mean, Double today, of course, is one of our most successful portfolio companies, operating in 3 markets, doing hundreds of millions of revenues. But well, what happened there is John and Dave, they really wanted to have Yolo in their cap table. They found a way, and we got reconnected through a common connection, somebody who Tim went to school with, and then we jumped on a call, and it kind of everything progressed from there very quickly. But this is something when I see John or Dave, I still apologize sometimes.
Brilliant. And John and Double, of course, doing incredible work now over at Double. So Evert, I'm curious as well to know. So you now set up the second fund. It's a actual professional VC fund now with limited partners. How does a fund like this actually work? Like, how do you make money? How does the fund make money? How does the LPs make money? How does all of a fund work essentially?
Okay. I think the first kind of section is the admin side. I'm just going to put that aside for the purpose of this discussion, not to say that isn't important. So that would be legal, fund accounting, LP reporting, all that side, audit. But from a pure portfolio construction perspective, there's probably 5 things you need to get right. And conveniently, they all start with an S. So first off, you have sourcing. So how do you get the best deals on your table? Like, how do you see them in the first place? Because you can't just wait around and hope good entrepreneurs reach out to you. You need to be proactive here. Then we get to selecting, which is you have a few great deals on the table. How do you pick the one to invest in? After that, we get to securing. So the very best deals, there's competition. You need to win the deal. You need to prove to the founder that you're the VC they should get in bed with. Then we get to servicing, which is that's the value add side of things, portfolio management. How can we support the founder along the way? And lastly, everything has gone well. We get to selling, which is often overlooked, but at the end of the day, any fund needs to sell, and the fund performance is only assessed by actual cash returns.
Yeah, brilliant. So there is that journey from the very beginning of the top of the funnel, let's say, to find the prospect, to then eventually making that expert with a good multiple on top, hopefully. And if we turn the table down from an LP, say that you want to be an LP and the Yolo Investment Fund 2, which unfortunately is difficult at this stage, as you already managed to succeed on that front. But for those who are interested in, they may have a little bit extra money, they made it from somewhere, and they want to now start to invest as an LP, how would you come on board to Yolo to be part of this journey?
Yeah, I'm afraid for Fund 2, you're probably a bit late as we've closed the funds. But for any future funds, which we're very much planning to do, just feel free to reach out and let's have a chat. There's not that many restrictions there, but I mean, of course, we are a regulated and a licensed fund, so our fund administrator will need to make sure you're not laundering Russian drug money, but if that's not the case, all good.
Yeah, brilliant. And I want to talk as well about the iGaming investment landscape currently. So, the traditional VC model out of Silicon Valley, Sequoia Capital and all the major investment fund, Peter Thiel's investment thesis, they are all centered around kind of don't go for tier 2 investment opportunities that might 10x or 20x. The only thing that matters is to find these 100x's or 1000x's that will basically make the fund a successful fund, right? If we look at the iGaming industry, it's difficult to find these multi-billion opportunities that you would see in the tech industry. So I'm curious to understand a little bit what does the investment landscape look like in the iGaming industry? What are the quality of investment opportunities that you come across? And then what are you looking for in YOLO? What type of returns are you looking for in general?
I think that is correct, that the distribution of returns is somewhat different in gaming, but that is not to say that you can't achieve the same IRR. Like if you have a better hit rate, but maybe 10x investment as opposed to 50x, you can still achieve the same returns on the same kind of time frame. But I very much believe there is alpha to be found in gaming, and like, that's why, of course, we invest in gaming. But I feel there is a bit of a misperception here that it's easy, or like there's money growing on trees when you invest in gaming. Almost like some time ago, it felt like there's a new gaming fund popping up every week, just going through next news. But it is challenging, and I think people don't really talk about this. And the first point would be it's a small industry at the end of the day. There's not that many deals. In our stage, it's maybe like 5 deals per year, and like we need to see them and we need to win them. Then there's the concept of a regulatory risk, which makes gaming very special. So I think crypto casinos is a good example here. So last 6 months, perhaps the best teams I've spoken to have been young founding teams of crypto casinos with very good products. But the challenge is, I'm afraid these businesses will never IPO. The group of buyers is very limited, and when you do exit, you exit at 5x EBITDA. So it's challenging to make the traditional VC model work when you have to deal with so-called shades of gray. B2B maybe is a bit easier. You could always say, look at Hacksaw, and it's a very good counterexample. Like, what is it? 70-80% of revenue is pre-regulated, but trading at a very healthy multiple. But I mean, don't get me wrong, it's an amazing business. And if you grow 100% year over year with 80% EBITDA margins, maybe the markets just don't care.
But then at the same time, even if you launch a crypto casino as a really talented founder today, just like Ed Craven and his co-founder did in the 2010s, eventually the business might become so big and powerful that you start to pivot over to becoming a more regulated business. So maybe it's part again of why you would want to invest in that founder, and eventually they'll figure it out along the way, perhaps.
Yes, for sure. And like, don't get me wrong, these businesses may be, financially speaking, very good investments. And the fact they don't fit into your traditional VC model, that's absolutely fine. Like, you can have an alternative structure that maybe creates most of the returns from dividends, and then you're fine. Yeah. There's maybe another point. Also, what I think is interesting, but I haven't heard anybody talk about this, is like, could there be, we have a bit of a handicap in gaming when it comes to like propensity for good talent. And what I mean by that is gaming still has like ethical stigmas, or like there's a group of people who don't want to be in gaming because it's gaming. And like, there is a philosophical argument here, which, like, if you have a generational founder, call it Elon Musk, do we want him or her building the next gamification, loyalty, AI retention tool that improves Betson's first month retention by 2 percentage points? Or do we want them to build rockets and cure cancer? Or okay, I'll stop there. There is a saying in Estonian, you shouldn't like cut down the branch you're sitting on. But but there is always exceptions to this. But there needs to be something special happening to bring these people to gaming. And like, I honestly believe Tim is a great example of this. So Tim is a founder who would do well in like any industry, but he grew up next to a race course. Something clicked there. He's in gaming. I mean, you, Pierre, you like, what was it, running underground poker clubs in Sweden? Like, I'm not sure if I'm allowed to say this, but something clicked there, and now you're in gaming. So there is something there.
Yeah, I like the I like the consistency of certain founders or people who are not just entering an industry because they see an opportunity, but because this is what they were meant to be doing. It's like they are vibing with the industry to some extent. And I think, what Tim did, obviously, he's been a gambler his whole life himself, right? Like, this is what he loves to do. This is what he still loves to do. He's at his own casino, he's playing, he's out with his own VIP players. This is just his personality that is clicking, as you mentioned, with his professional work as well. And there's some magic that comes from that when you bring in your passion into your work life, right? I don't believe that just because you have a passion you will succeed in anything, but like, if passion clicks with opportunity, right, then there's a different energy that comes from that, rather than someone who just sees an opportunity and they go into it with maybe not their full personality as well. Where do we spend our energy on a day-to-day level? If we merge our passions with our business, then you can be sure that there's a multiplier there of that energy that goes in and the output that comes from that. And I think that is, what you saw with Elon Musk, for example, as well in the 90s. He decided very early on that there's like a few things he wants to tackle for the future, welfare of the humankind. Is like, we need to go to space, because we are polluting this earth. We need to transfer into electricity vehicles because we are using too much oil and global warming and so on. And he just made these things his mission that he falls back on for his entire career, right? So it's very like simple ideas that have been driving him for his whole career. And I think it's similar in the story of Tim in that regard, that he's just like incredibly passionate, right? And you feel that he's answering your Telegram messages at 3 a.m. I mean, he loves it, right? That's just the way it is, and that's what you want to see, I suppose.
Yeah, this is where the magic happens. But yeah, my point is, it's unfortunately probably a bit more rare to get this magic clicks in gaming or maybe entertainment in general. But I mean, there's a flip side to this. If there's a founder and this kind of click happens, there is more opportunity because it's easier to shine through all the noise and really stand out.
Yeah, exactly. Right. Like, if you want to go into, say, saving the polar bears in Antarctica, you're in competition with a lot of other people who want to embark on that journey, let's say, or a lot of other more mainstream kind of ways of pursuing a passion or a life goal, so to say. Whereas in gambling, like you said, there's already a filter there where it is a stigmatized industry, so you don't tend to fall into the industry and pick up that passion later on. It's more a thing, as you mentioned, circumstances lead us into the industry from early age, and it's not the most common industry to develop a passion for. But if you do it, then you have a big advantage against most other people in the industry, for sure. I want to ask as well, if you look at the portfolio and in general, when you think about the investment that you make, how many end up succeeding and how many investments end up failing? Like, if you think of an average kind of thing for Yolo.
Mm-hmm. That depends a lot on how do you define succeeding. There's, I guess, with any portfolio that has a similar vintage to us, there is a group of businesses that are somewhere in between today, and like that's one of the not beauties, but one of the things you need to consider in venture. Like, you make the bet, but actually you'll know in like 5 years if it was the right bet or not.
Yeah.
And during that time, of course, you get some signals and trends, but at the end of the day, you don't know. When we talk about actual numbers, I think the very widely kind of quoted metric of call it 90% fail rate, that if we're being very conservative on our portfolio, that would hold true.
It is the point that, like, you make really great bets, or really great opportunities, but actually most, let's say a majority of startups still end up failing along the way, right? It's difficult to find product market fit, but then the opportunities that do end up succeeding, they obviously carry the whole fund, because when they succeed, they tend to succeed really well. That's the idea, right? Yes.
Yep.
Uh,
That's the
so
power law, which like that everybody kind of knows it applies to startups, but what people don't often talk about is that it applies to funds as well, which I think that's an interesting idea too, that like a median or average VC fund is not a good investment that any LP should actually consider, because if you look at the last 20 years, venture capital as an asset class, the return is basically the same as S&P 500. It's maybe like 1 percentage point higher, but it's so illiquid. So obviously there should be much higher illiquidity premium. You should be compensated for this and get higher returns. So as an LP, if you really want to make money in venture, you need to invest in not the average fund, but the best funds. It's the top decile funds that generate good returns. So like power law applies both ways.
yeah, yeah, and that's the idea. It's like as a VC, it's like you want to deliver these great returns. That's the purpose of the VC, right? Like otherwise, you do hedge fund investment if you want to kind of sail on a pretty more like a more safe kind of return on a year-to-year basis. But the VC is obviously a more risky way of investing.
And you're only like as good as your last fund. So this is also something we're very conscious of. Like we full on see a future for Yolo as a fund manager, but I mean, we're on fund 2 and I'm super conscious for there to be successful fund 3. We need to deliver results with fund 2.
Yeah, exactly. It's hard to pitch to new investors to come on board to fund 3 off the back of a failure, right? So there's a lot of pressure on
For sure.
to really succeed. Final question here for you today, Evert, before I let you off for today. Let's look into the future a little bit. So where do you see Yolo Investments in, say, 3 years' time? What is the bigger goal that you're working towards here?
Okay, I will keep this answer very specific. So Fund 2 will have generated meaningful DPI, which is actual exits and money distributed back to the LPs. LPs are happy with the returns, and 3 years you said, I think. So Fund 3 will be up and running and will be aggressively deploying into good deals.
Good news for the startup ecosystem in the industry ahead, in other words. Evert, thank you so much for coming on board. Congratulations with the massive success of Yolo Investments. Obviously now at this point a staple in the iGaming industry as a leading fund. If you are an exciting startup with an exciting idea or an exciting entrepreneur, you heard it before, reach out to Evert. Find a way to reach out to him. Find a way to organically make that connection. And I think Evert is open for ideas. So yeah, thank you so much, Evert, for today.
Thank you for having me.